Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Michael Berolzheimer of B Partners. Michael, thank you for joining us.
Thanks for having me, Hall.
So can you tell us how you got into early stage investing, what you did before, and what you're doing now?
Sure. I like to think about it as a previous life, which I would hope that most of your listeners would also have. We go through so many different fits and spurts in our careers, but in a previous life, I was in New York in both investment banking and private equity. And that feels like a generation ago, given how long I've been early stage investing. I made my first angel investment in 2004 and literally have not looked back since then, focusing exclusively on startups, starting a couple of companies myself, and then now fast forwarding to today, investing across 54 separate companies since the inception of my investing career at the earliest stage. So it's been quite a journey to get to where we're at today. And we feel so fortunate to have the opportunity to work with the founders that we work with on a day-to-day basis.
So you call the name of your fund B Partners. Can you tell us how you chose that name?
Sure. So when I was an entrepreneur, I was exploring investors. I was trying to find the right investors for us to partner with. And what I found were quite a lot of angel investors that wouldn't necessarily provide support, and they would write small checks. And then you would find folks who would write really large checks, but then we were too early for them. And so there was no sweet spot. There was nobody out there that was really writing large checks and applying a great deal of time and energy into the relationship and into the investment. And so when I decided that the entrepreneurial game was not for me, and instead I wanted to focus on my path in the investment world, I decided to name the firm B Partners to exemplify the relationship that we aim to have with those founders. We want to be partners with our founders. And that is not just for a couple of months, like an accelerator. It's not for a couple of years, like a traditional investor. It's for a lifetime. And so we see our partnership model as a lifetime partnership with the founders that we ultimately select. It's a long road of entrepreneurship, and we aim to serve them throughout the course of their entire journey as an entrepreneur and a CEO.
So your fund, what exactly do you focus on? What do you look for in startups?
Yeah, we focus at inception. We were very proud to have been the very first investor in over 60% of our companies. And this is first investing before mom and dad and Uncle Bob. And so this inception stage of capital investing requires us to take a big, bold bet on founders. All of our companies that we've ever invested in were pre-product market fit. Most of them had never had revenue before. Most of them had never had a customer. And so we really focus at that stage and seek founders who share a vision that we have internally about technology innovation and the pace and speed of innovation impacting the breadth of the economy, both here in the United States and rest of the world. And so we focus really on entrepreneurs who have deep market insights around their particular industries and sectors and can show us the path towards a new future that we can all subscribe to, and we can live that mission along with those founders.
So what criteria should a startup accomplish before coming to you? Product market fit, revenue? What are you looking for that they've done that says, okay, now they're ready for me?
It's a good question, Hall. For us, it really comes down to the prior experience of the founder, and that's not necessarily that they had to have worked in a big tech company or had to have had some pedigree being a graduate of UC Berkeley or Stanford or what have you. It's really about their life experience. It's that the path that has led them to the point that they're at today is a path that is hyper relevant for the startup that they're aiming to build for tomorrow. And so we'd like to think of this not as product market fit, but as product team fit. And you can get to, or really startup or problem team fit. And you can get to that without getting to product market fit. And that is more important than anything else as far as we're concerned when it comes to evaluating an opportunity. So our recommendation to teams is get to problem team fit and be so hyper passionate about it that it doesn't matter whether you're going to get funded or not, you're still going to pursue the problem. And at that point, and if you know it into your marrow, call us. We'd love to hear why you're so passionate about solving that problem.
So for the investors in the audience, they always ask me what's the investment thesis is. What can you tell them about your investment thesis and why your approach is going to provide a good return?
Well, that's a good question. I mean, so far it's worked well for us. Our returns have been quite good. But the thesis is that it is extremely difficult to filter through the noise that exists at the earliest stage. And we have proven an ability to do that over a couple of cycles. And we believe that pre-seed is an outstanding place for generating excess return. And we think that it's the best spot in the venture market to be able to do that. Importantly, we think that we're on yet another cusp of innovation, and we believe that into our own bones as well. And we'd be delighted to talk to investors about what that means. But you combine the two of this next wave of innovation as well as pre-seed, and we're confident that we've got the right recipe for excess return.
Can you talk about one or two startups that fit that thesis and why you invested in them?
Yeah, sure. So the first company I'd like to share with you about is a company called Skycatch. The founder came to us in really mid-2012 with this harebrained idea of flying drones over construction sites and pulling data, whatever that data may be, and giving it back to people on the ground for them to do better work and faster work. And that was an intriguing idea. At the time, drones were thought of as really a military application, not as a commercial application. And you take one step on a construction site, and it is a complex system that is choreographed by a variety of people on the ground. And so we loved it. We really aspired to Christian. He had been building his own drones for years. He had lived the construction industry as well, and had hustled his way to flying drones over sites really without anybody's permission. And so as a result of that hustle and our prior experience with him, we backed him. We were his first check. Fast forward to today, he's raised tens of millions of venture. He's got a very healthy pipeline of customers. They're flying drones over sites. We believe that they have the most drones flying over commercial sites than any other company in the world. And they are saving companies millions and millions of dollars every day. And it's becoming a critical element of general contractors and construction companies to leverage data coming from drones as they're thinking about what we like to call smart construction. And I think, again, it exemplifies the stage at which we like to invest in. It exemplifies our belief that machines will win, and exemplifies the type of founder that we look to partner with.
I've noticed a number of funds actually look for the hustle factor, and they look to see how much the company can do on their own without much or any funding in the area of product development and customer acquisition. How much are you looking at that, and how much does that weigh into your investment decision?
Well, it does factor into it, but you just mentioned customer acquisition and product development. And customer acquisition and product development sound like traction. And so, for us, we don't demand companies necessarily demonstrate traction per se before we actually write that check. So one of the things that most investors will pass on companies on is this broad bucket that they will say it's too early. And how many founders have heard investors come back to them and say, come back to us when you've solved this, or come back to us when you've made more traction, or come back to us when you have a couple of customers. And it drives entrepreneurs crazy because investors will say, hey, we're the earliest investor you ever met, and we invest early and we're an angel. And then there's this mismatch between what they hear from the investors and what the reality is on the ground about their company. And so we don't ever pass because it's too early. So again, what do founders need to do in advance in order to reach towards a term sheet with B partners? It's going back to that problem team fit and then demonstrating a fabulous story and really thinking about being very, very thoughtful about actually raising capital and why to raise capital. And we think that's a really important thing that most founders miss is why raise capital in the first place? Because there's so much progress that can be made without capital that sometimes the capital approaches or the venture capital path is not the optimal path for certain founders. And we like to have those conversations with founders along the way.
What are the common mistakes founders make in actually taking funding and moving forward into a VC relationship? What do you think are the biggest challenges or mistakes you think you see them make?
In a post-funding environment, huh?
That's right. After they take the funding and they're ready to go and they're on the right path, what mistakes do you see them make that you wish they did?
Yeah, we see a lot of founders have excess positive bias about a piece of data that they've received from some signal that they conclude is some piece of information they conclude is signal when it actually isn't. So a customer will tell them one thing and they'll hear it twice from two separate customers, and then they'll go build it and try to sell it, and the customer doesn't want it. It's wrong. So they have insufficiently prioritized or weighted certain activities or things that the customer said in the wrong way. We see founders focus too much on cap tables and focus too much on ownership and not focus enough about customers, not focus enough about product. And what that leads to is it really doesn't matter what the cap table is if the company's worth zero. And so we really are trying to focus our teams on hitting real milestones, real tangible operating milestones more than anything else. I think the other thing we see founders kind of trip on a bit is firing too slow because they feel like they have some attachment to that individual, but the individual's underperforming. And being really ruthless about finding exceptional talent and letting go of talent that is not supporting the aggregate team, because all about speed at the earliest stages of venture creation.
Well, that's very helpful information. In the final few minutes we have here today, what else should we cover that we haven't?
Well, I think what we should cover is the partnership that we think that founders should really pay attention to when they're considering their investors. It is critical for founders to see the relationship that they are about to enter into with that investor as a potentially a lifetime relationship. It takes a long time these days. It is not easy to build a foundational business. We encourage founders to walk away from investors who they really may not believe have their best interests in mind. And because life's too short. And at the end of the day, the people that you partner with is a reflection of who you are and what type of startup that you want to build. We really encourage founders to be doing as much of the interviewing of their investors as the investors are interviewing the founders. The other piece of that is to expect more from investors. Expect way more than capital. I mean, capital is so fungible these days. It is so easy to raise capital these days from platforms, crowdfunding, equity crowdfunding, the angel networks, and investors like us at B. There's plenty of capital out there. So expect more. Expect real, tangible service, and for us, it is additional capital introductions and the like. It's customers and kicks and hugs along the way. And that type of deep support is critical for founders, and we think that they should solve for it.
That's so true. There's so much more funding today than there has ever been before, and there's so many more different types of funding and deals out there that it seems like with the right homework and approach and effort, you can get even better sources of funding than you did before.
Yeah, I think that's
But
right.
It takes time.
Yeah, I think that's right. Absolutely.
Well, how best for the audience to get back in touch with you?
To get in touch with us, the best way to reach us is through our website, bpartners.vc/contact. There's a very simple form that we ask founders to fill out. It's better even than sending us an email or throwing something over the wall. Fill out that form. We'll get back to you. We aim to get back to founders within 48 hours. And look, if you know somebody in our network, that's fabulous too, but the website's sufficient for us as well. And look, if we fit your model, if we fit how you want to start your business, great. And we're excited about partnering with you. And if we don't, that's okay too. We're going to root for you from the sidelines.
Well, that's great. Well, I appreciate you taking time to share your insights with us and your experience with the audience today, and hope to have you back for a follow-up very soon. And appreciate the thoughts that we've shared out today. Thank you so much.
Oh, thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.